our market master, Abhay Laijawala, Head of India Research at Deutsche Equities. Morning, Abhay.
Morning.
Thank you very much for dropping by.
Thank you for having me.
Well, first up, with markets so gung-ho, as we cast our eye on your report, you have a Sensex target that's 29,000, a tad lower than where we are already. So you aren't expecting immediate gains or some headwinds?
Yeah, so our view is that before you really see any kind of an up move, you do need earnings to recover. And at this point in time, we're seeing that expectations for FY18 appear to be on the higher side. So I think what the street has done over the last couple of months is they have made revisions to the FY17 numbers on account of the various factors, including, of course, demonetization. But they have not necessarily touched their FY18 forecasts. So arithmetically, you've seen earnings cuts for 17. You haven't seen similar cuts for 18. And therefore, the base leads to an amplified year-on-year increase. And it's a year in which we are going to see a transition. In fact, India's taxation system is transitioning from a developing world system to better than a developed world system. That has to have its transition impact. There will be a near-term disruption. And therefore, our sense is that consensus earnings expectations for FY18 are on the higher side. So to that extent, therefore, our sense is that until we see earnings expansions, it's difficult to expect the markets to re-rate.
Okay. Abhay, hi, good morning. Always a pleasure speaking to you. As we head into earnings season, which are the sectors or pockets that would make you a bit cautious now, where you expect earnings to be slightly on the weaker side this time around?
We think that sectors like IT services, sectors such as autos, these are sectors where we expect the earnings to be relatively sedate. We are also looking at banks. In the banks, obviously, earnings will appear to be amplified on a year-on-year basis, because last year in the fourth quarter, you had the credit costs going up on account of the high provisioning. That will obviously not be there this year, and therefore earnings will appear to be high. But obviously, with loan growth under pressure for the entire system, and with treasury gains also not being there, like you had seen previously, overall earnings may probably disappoint. Remember, in the December quarter, treasury gains for the banks had constituted close to 20 to 25% of the earnings. That will obviously be not there in this quarter.
Okay, so banks may disappoint in spite of the low base.
That's right. Okay. That's right.
Well, actually, I was going to pick on that theme. In your underweight category, you have financials, healthcare, industrials, and telecom.
Yeah.
While others are self-explanatory. Financials, what would you classify as underweight? Are you not even bullish on what seems to be the evergreen sector through 2016 NBFCs?
No, we are. So let me lay out what our thesis over here is. Our thesis, as far as the overall sector is concerned, is that there are more headwinds than tailwinds at this point in time. Loan growth has come off. It's at about 4.2, 4.3%. It's a multi-decade low. And yes, this could be on account of the disintermediation. We are seeing bond markets come in, and probably if you add bond markets to loan growth, then it's not as bad. But for the banks, obviously, it is lower growth. In addition, there will be pressure on NIMs as we move forward. Net interest margins for the banks are going to be under pressure, with banks being flush with liquidity, as well as loan growth slowing down. And in addition, the environment for treasury gains also appears to be muted. Now let's break up the sector, and within the sector now, let's look at the smaller banks. Okay. So the smaller banks are today, the smaller private banks are today in a very positive situation, because A, they are small, and clearly there is a premium. Small is beautiful at this point in time in the Indian banking industry. And they are growing. They are probably growing at 3 to 4 times the system loan growth. In addition, they are taking market share away from many of the public sector banks. So our bank's analyst Manish Karwa forecasts that public sector banks are likely to see the market share drop from 66% right now to probably about 60% in the next 5 years. And a large part of that market share will be taken by the nimble, smaller banks. In addition, we also like some of the NBFCs, because obviously if the banks are going to be compelled to cut deposit rates, the wholesale funded banks, wholesale funded NBFCs will be gainers. So, you know, this is what therefore our strategy is. With overall underweight banks, within banks, favor smaller banks, favor those banks that are focused on retail and least focused on the corporate side.
Okay, that's about banks. I was going through your top mid-cap ideas, and it's interesting that you have a lot of interest in some of these rural plays, whether it's UPL, whether it's Shriram Transport Finance, and a couple of others as well. Are you positive, or are you hopeful of a good monsoon this time? And is this the best time to play the rural theme?
So there are concerns with regard to the El Nino this year, and the Australian Bureau of Meteorology has forecast that there is a high risk of an El Nino setting in. But the timing of the El Nino appears to be perhaps July or August. So to that extent, perhaps the first part of the monsoon, which is important for the Kharif crop, doesn't look like it's going to impact it so significantly. In addition, as a result of the very good monsoon rains last year, we have seen parts of the rural economy begin to come back. Plus, we are positive on the rural side also, because we hear that the government's revised estimates for food grain production are predicting a very robust growth. Plus, we were also very encouraged to see that horticulture production in India has also been the highest in a long time. So clearly, food grain production being very high, horticulture production being high, a very good monsoon last year. So there is a feel-good effect coming back. In addition, the normalization following demonetization is also setting in. So all of this should bode very well for the rural economy, particularly in the June quarter.
And hopefully there won't be too much of a GST hiccup there.
Let's hope so.
I have always known you for a very long time as the best expert on metals. So tell us how you will play the industrials. Where is it? It's coming in underweight. But there is still a decent amount of, higher prices for global metals. You're not touching them now? You think they're priced?
Actually, on metals, we are overweight. So on materials, we are overweight.
Okay, sorry. Industrials will be capital goods.
That's right. That's right. Materials, we have been overweight now. And within materials, the preference is for metals and mining over the cement producers. And for metals, the good times are set to continue, at least until the plenary in China in July. There is a very strong expectation that the Chinese economy will remain robust, with fixed asset investment staying robust until June or July. But perhaps sometime in July, we will have to see what China is doing, because with pressures coming back, China may look at cooling the economy, given that debt to GDP is already in excess of 250%. But yes, until then, metals do look very good. Even as far as the domestic scenario is concerned, it's very encouraging to see that the government has been very proactive on the metals front. This morning as well, we have heard that the import duties, the hurdles for imports on hot rolled coils have been raised. Hurdles on cold rolled coils have been reduced. Now, this is very positive, because this morning we've also heard that Chinese steel companies have cut steel prices. And this could obviously lead to worries that Indian steel producers could cut prices. But with the developments of this morning, Indian steel companies will probably be insulated from the global pricing decline. In addition, coking coal prices have moved up. I believe coking coal prices are now at about $290. And this will probably allow Indian companies to pass on some of the pricing pressure.
Okay, well, Abhay, we've run out of time, but thank you so much for your thoughts. Always a pleasure speaking to you, and we'll know in a few days from now what the earnings season actually throws up.
Perfect.
But looking forward to speak with you again.
Thank you.